This is our group member.
Good day, Doctor and my fellow friends. I'm Yun Han and we are from Group 1. Today we are going to present the Group Project 2 for Portfolio Management. An investment portfolio is a collection of financial assets aimed at generating profit and preserving capital. Diversification is the spread investment across various asset types which help manage risk. Our equity portfolio includes 5 local and 2 international stocks from different sectors, enhancing diversification and growth potential. We aim to assemble, rebalance, and evaluate a diversified portfolio. Starting with 500,000 ringgit, our trading period was from 4 January to 24 June 2024. Initially, we invested in Mr. DIY Group, Axiata Group, Public Bank, Gamuda, and Vitrox. On 4th May, we rebalanced, adding Pavilion REIT. On 1st June, we added Pavilion REIT and United Overseas Bank. Trading concluded on 22 June, and we evaluate our portfolio's performance, focusing on achieving investment goal through diversification and rebalancing. Next, we will talk about the economic analysis. Economic analysis evaluates a topic from an economic perspective, guiding investment decision. We analyze 4 economic variables which are GDP growth rate, import and export, income level, and inflation rate. So now we will talk about the GDP growth rate of global and domestic. In 2023, saw global GDP growth above 3%, with a 2024 projection of 3.1%, driven by recoveries in major economies like the US, China, and the EU. In Malaysia, GDP growth normalized to 3.7% in 2023 from 8.7% in 2022. Quarter 1 2024 growth was 4.2%, boosted by export and domestic demand, supported by government stimulus. And next is the import-export of global and domestic. Early 2022, global trade rebounded, with goods and service increasing by 1% and 1.5%. China, India, and the US lead this growth. However, in Malaysia, May 2024 saw a 7.3% export rise, driven by electrical product and palm oil, and a 13.8% increase in imports, driven by intermediate goods. Malaysia maintained a 49 months trade surplus, reaching 10.14 billion ringgit. Next is the income level of global and domestic. Low-income countries dropped from 30% to 12% since 1980s, while high-income countries rose from 25% to 40%. Asia and Africa saw higher income growth due to rapid industrialization. However, in Malaysia, average salary expected to rise by 5.1% in 2024, reflecting economic recovery and higher demand for skilled workers. Lastly, we will talk about the inflation rate of global and domestic. Global inflation expected to decline from 6.8% in 2023 to 5.9% in 2024 and 4.5% forecasted in 2025. However, in Malaysia, 2024 headline and core inflation rates projected between 2% and 3.5% and 2% and 3% respectively, due to stabilizing demand and controlled cost pressure. Malaysia shows resilience and growth potential amidst global uncertainties, with strategy measures and policies fostering economic stability and growth.
Retail transactions occurs when a customer wants to utilize a good or service for domestic, family, or personal purpose. A retailer is a business that offers product and service to clients directly. Mr. DIY, our company, is a retailer of mass commercial and home improvement products. In 2023, the retail trade sector in Malaysia is projected to generate around 8.6%. The banking industry in Malaysia has reached the third stage, which now as the maturity stage of the industry life cycle. It plays a crucial role in the country's economic expansions by providing finance funding through loans to support various economic activities. According to Bank Negara Malaysia, Malaysia saw a considerable increase in e-payment transactions, with 170 transactions per capita and 6.6 billion ringgit in e-remittances process. This shows how digitization has helped the banking industry to develop. The financial industry in Malaysia is projected to have a GDP of 82.37 ringgit billion in 2023. Digitization is vital to the banking industry competitive landscape. To effectively manage the regulatory environments, banks must anticipate and prepare for applications pertaining to IT procurements, consumer protection, financial stability, and security measures in the future. That a growth in the Malaysian banking industry is anticipated in 2025. Many factors, including expanding net interest margins and anticipated increases in OPR, should propel the majority of banks to attain a return on equity beyond 10% by 2025. As a result, the banking industry has significant room for future expansions. The telecoms market in Malaysia has expanded rapidly in the last several years, and this growth pattern is anticipated to continue until 2025. The national adoption of mobile phone that enable 3G, 4G, and 5G service, as well as the growing urban populations, are the primary factor contributing to the industry expansions because of the interest of things IoT, which is connected to both wireless and wireless broadband connections in the telecom sector. The industry is anticipated to develop rapidly throughout the projection period. The majority of mobile connections will be 5G by 2029. By 2025, it is predicted that the majority of connections will be mobile, with fixed broadband connections likely to reach hundreds of millions and voice connections exceeding tens of millions. Besides, Axiata Group Berhad is an investment holding company based on Malaysia. The company's main business is offering management and technology service across international products. Changes in national and international regulation and policy can have an impact on the telecommunications sector. Telecommunications companies need to continuously innovate and set themselves apart from competitors in order to increase market shares and retain consumer loyalty. This industry is an important element of Malaysian economy because it is widely linked with many other parts of the economy such as basic metal products, which include the iron and steel industry and electronic. The Malaysian construction market is less competitive due to major international players holding a largest share of the total market. Furthermore, the residential and transport construction sector have a harsh potential for a growth in the forecast period, which stimulates opportunities for other market players. Some of the major players in Malaysian construction market are Gamuda, UEM Group Berhad, and Malaysia Resources Corporation Berhad. The GDP of Malaysia's construction sector is predicted by statistics to increase to around 56.66 ringgit billion in 2023 in Malaysia. Because of on the back of government spending on infrastructure projects, it has made the construction industry maintain a positive growth outlook over the next few years. On the other hand, labor shortage, increased raw material costs, and rising interest rate has continuous impact on the local construction sector. The technology industry is made up of business that create, produce or sell electronic items. Compared to most other sectors, this one is very unique in that it demands exceptionally large investment in R&D due to its quite speed of emissions. Consequently, compared to other industries, the industry employs a far higher percentage of engineers and other highly qualified technical personnel, especially because creating new products call for accuracy, inventiveness, and knowledge. ICT is a subset of technology. The ICT sector GDP in Malaysia is projected to reach 105.19 billion ringgit in 2023. Besides, it is hard to gauge competitiveness in the technology sector because of these threats. This is little competition by certain measures. Besides, the speed of development and change into technology is increasing, resulting in a faster rate of change. The 6 primary property kinds in the real estate market are rent, hotels, office, commercial building, industry building, and residential building. In reality, every kind of property serves a distinct market set of customers and functions. For instance, an industry warehouse and apartment may have very different development requirements, yet they both belong to the same institution framework with regard to property, funding, legal considerations, and even building. The real estate sector in Malaysia is expected to generate a GDP of 24.37 ringgit billion in 2023. Besides, green building and energy efficiency measures will provide business a competitive edge as sustainability becomes a major factor in the real estate industry. Moreover, developers and investors now have the chance to reconsider their approaches and adapt to the shifting demands of the industry. That's all for me. Thank you.
Greetings and good day everyone. My name is Tanjawan, number batch 285366. Currently, I will continue with the fourth part, which is fundamental analysis. Firstly, Business DIY Group, the largest home improvement retailer in Malaysia and Brunei. From the calculation, observe a stable profit margin and a high ROE reflecting a solid financial structure. Key reasons for choosing these stocks include its exceptional revenue growth, aggressive expansion strategy, and strong international presence. Technical analysis further supports a bullish output, making Business DIY a completing investment choice. Secondly, Public Bank Berhad, a leading financial institution in Malaysia, has shown strong financial performance with increasing net profit margins and a steady ROE from 2021 to 2023. The bank's undervalued price-to-earning ratio and improved debt-to-equity ratios highlights its financial strength. With over RM 510.6 billion in assets and a diverse range of services, its solid financial and international presence made it accomplishing investment options with projected annual growth rank of 8.2%. Thirdly, Axiata Group, a leading telecom company in Southeast Asia, recognized in Malaysian Investor Relations Awards 2020. Despite recent profit fluctuations, the company's strong market presence, structural resilience, and upward stocks momentum is a solid investor choice. Its innovative financing and management stability further enhance its appeal. Berhad is a top Malaysian engineering and infrastructure company with a strong track record, known for projects such as MRT Line 2 and Smart Tunnels. From 2021 to 2023, it shows a steady profit growth and improvement returns. Gamla focus on innovation, sustainability, and expansion in Malaysia and Australia, along with its upward stock trends in 2023, making it a completing investment. Witros Corporate Berhad is a leading Malaysian technology firm specializing in automation vision inspection system. Despite slight profitability declines, Witros maintains strong technological leadership through substantial R&D investment. Renowned for reliability, they serve global semiconductor giants, ensuring high product standards. With improving financial health and a modest trend in 2023, Witros presents a promising investment opportunities. Next, Pavilion Real Estate Investment Trust is Malaysia's leading real estate investment trust, managing prime returns properties like Pavilion Kuala Lumpur. Despite fluctuating financial metrics, offers potential with its strategic location in Kuala Lumpur Golden Triangle. A diverse portfolio's investors benefit from stable return incomes and growth opportunities in Malaysia's expanding return market, making Pavilion Real Estate Investment Trust a competing choice for long-term investment. Lastly, United Overseas Bank Limited (UOB) stands out as a leading bank in Asia, with a global presence across 90 countries, with stable profitability measures and a diverse revenue stream, including strong positions in Singapore, Greater China, and other key markets. UOB offers solid investment potentials, and it focuses on both returns and wholesale banking, coupled with participants in global financial market, underscore its competitive edge in industry.
Good day everyone, my name is Sisimi and metric number 26521. Now I will continue the presentation with the analysis and discussion part. The selected stock in initial portfolio are Mr. DIY Group, Public Bank, Axiata Group, Gabunga Berhad, and Witros Corporation. The daily stock price for Mr. DIY Group, Public Bank, and Gabunga Berhad was remained stable through the year 2023. Public Bank and Gabunga Berhad daily stock price was slightly increased, while Mr. DIY Group has slightly decreased. Axiata Group and Witros Corporation has some volatility with the significant price movement. The first rebalancing was on 4 of May 2024, and we chose to leave Mr. DIY Group and replace it with Pavilion REIT. The stock price of Public Bank and Pavilion REIT had remained stable with minor upward move over time. Axiata Group and Gabunga stock price show some fluctuation with notable price movement. Witros Corporation Berhad stock price fluctuated significantly, which dropped from 7.45 to 3.70 in May. In second rebalancing, we had replaced Witros Corporation with UOB. Gabunga Berhad, Pavilion REIT, and UOB have a stable price movement, which mostly in minor upward on the trend, while for the daily stock price of Public Bank and Axiata Group is mostly downwards. For the return and tracking, Gabunga Berhad has the highest return with moderate risk, which means the possibility of higher earning and loss with low risk. Public Bank obtained a positive return with the lowest risk, indicating that this stock is relatively safe. Axiata Group and Witros Corporation have a negative return with the acceptable risk, showing that the stock were not performing well in the initial portfolio formation period. However, Mr. DIY Group has an extremely negative return along with the highest risk, demonstrate that the stock was significantly volatility. In first rebalancing, Axiata Group has the highest return with the highest risk, which means more risk and the possibility for higher earning or loss. Gabunga Berhad and Pavilion REIT obtained a positive return with acceptable risk, indicating that both stocks are relatively safe and offer moderate return.
Public Bank Berhad has a slightly negative return with the lowest risk, showing that the stock was stable but not performing well. The Trust Corporation Berhad has the highest negative return with higher risk, indicate that the stock was fluctuated and a weak performance. For the second rebalancing, the return of Gabungan Berhad is the highest with the higher risk, which suggests that the greater risk has the potential for higher return. The moderate return for Pavilion REIT and UOB with the moderate risk, which refer to balanced approach in investing. The negative return with higher risk of Property Bank and Axiata Group means that the company not only failed to generate profit but also experienced losses in higher risk.
Good day everyone, my name is Lo Zhihong, metric number 284269. So I will present about the CAPM and allocation. So the first table shows the correlation between the selected stock in the initial portfolio. The majority of the share in the portfolio has a lower and positive correlation with the other share, such as the Mr. DIY, Public Bank, Axiata, and Gamuda. So it indicates that the price fluctuations within the stock were less influenced by the others as they come from the different sector. However, Vitrop Corporation has a negative correlation with the Mr. DIY, Axiata, and Gamuda. This demonstrates that the Vitrop Corporate is not sensitive to the performance of the share. So all of the share have a positive correlation with the KLCI market index. It demonstrates that this share typically tends to move in a similar direction with the KLCI index. So by including the different share with the various correlation level with the KLCI, portfolio volatility and the risk can be reduced. So beside the next table show the CAPM and beta of the 5 selected share. Vitrop Corporate has the highest CAPM return, which means that the stock are significantly outperformed. Axiata has the highest beta, which indicate that it is very volatile relative to the market. So high beta stocks are risky and may offer the greater returns, but that can also result in loss if the overall economy decline. The last table shows the asset allocation. As we can see, Public Bank allocated the higher percentage of the portfolio. However, we have the lower allocation to the Mr. DIY. During the first rebalance, most of the share has a lower and negative correlation with the other share, indicating that the price fluctuations within the stock were less influenced by the others. Axiata Group has a highly positive correlation with the Pavilion REIT and the Gamuda, indicating that this share will move in the same direction. Gamuda has the highest correlation with the KLCI market index, implying that the Gamuda stock price move are strongly linked to the market fluctuations. Next table shows the CAPM and beta of the 5 selected share during the first rebalance. Pavilion reached the newly acquired share has a relatively low beta when compared to the other share. This implies the minimal volatility of the Pavilion REIT stock price in relation to the markets. Furthermore, its expected return is less than the market return, making it an excellent investment. Axiata Group has the highest beta. It is risky and may provide a larger return, but it can also result in the huge loss if the overall economy is failing. In comparison, Vitrop Corporation beta is negative, showing that it was likely to go in the opposite direction of the market. For the asset allocation in the first rebalance, Public Bank still allocated the highest percentage of the portfolio. However, Vitrop Corporation has the lower allocation with only 1.05% due to the bad performance in the initial portfolio. Next, the table shows the correlation between the 5 shares in the portfolio of the second rebalancing. Pavilion REIT has a negative correlation with the other 3 shares, which are the Public Bank, Axiata Group, and Gamuda. The negative correlation means that the Pavilion REIT is not sensitive to the change of this share. Moderate correlation between the domestic stock like the Public Bank, Axiata Group, Gamuda with the KLCI index suggests that these stocks are significantly influenced by the KLCI index as a worrying rate, and this should be considered in the investment decisions. However, the negative correlation between the Pavilion REIT and UOB with the KLCI market index means that when the KLCI index rise, the stock price tends to fall. So we choose both to help to diversify the unsystematic risk as this stock will move in the opposite direction. According to the next table, Axiata Group has the highest beta. It indicates the share has the greater volatility than the market. Beta is used to calculate the CAPM along with a 3.2 risk-free rate and the market risk premium for the predicted return. The next table shows the distribution of the investing fund. For the international share, UOB, which decided to invest 30.74% of the fund during the second rebalancing period. Meanwhile, we still invest the largest fund in the public bank, while the lowest fund invested Axiata Group.
Hello everyone, my name is Tan and my lecture number is 28619. Now I will continue to present about profit and loss and benchmark of our investment portfolio. For the initial portfolio, we lose around 12,000 ringgit of our investor funds. We get the most loss for Virtual Corporation Berhad, which is around 32,000 ringgit. We also get the loss from Public Bank Berhad, which is around 11,000 ringgit, but less than the loss from Virtual Corporation Berhad. We earn the profit from Mr. DIY Group Berhad, Axiata Group Berhad, and Gamuda Berhad, but the profit is unable to cover the loss. Since we had earned the least profit from Mr. DIY Group Berhad, we stopped to invest in the company and invest in Pavilion Real Estate Investment Trust in our first rebalancing process. After we done the first rebalancing process, we earned around 20,000 ringgit of our investment fund. We can see that we get loss from Public Bank Berhad and Axiata Group Berhad with a small amount of our investor fund. They was be covered by the profit they earned from Gamuda Berhad, Virtual Corporation Berhad, and Pavilion Real Estate Investment Trust. Through the analysis of profit and loss, we can see that Pavilion Real Estate Investment Trust has generated the most profit to us, and the Virtual Corporation Berhad has generated the lowest profit in our first rebalance portfolio. So, we proceed to change this company with the international stock, which is United Overseas Bank Berhad. After we done the second rebalancing of our portfolio, we lose around 800 ringgit, but it still earn profit for the overall investment portfolio. In second rebalancing portfolio, there's only Gamuda Berhad generated the profit for us, and the other stock is underperformed. Since the profits from Gamuda Berhad is higher, we can cover a bit of loss from other stock. To finalize the investment portfolio, we can see that we had earned around 7,000 ringgit after reducing the cost of investment, and it is clear that the overall balance remain is higher than the initial portfolio. We have found out the reason of portfolio and loss in each process. For the initial portfolio, we get loss is due to the unexpected drop in Virtual Corporation Berhad's stock price, and for first rebalancing, we get profit is because the improvement in portfolio value demonstrated the appropriate asset allocation and attractive economic conditions. In the second rebalancing, we get loss is because an inconsistent performance with moderate market change. Next is about the benchmark. We have compared the portfolio return with market return. The initial portfolio was worse than the market due to the selected stock, and the relative weightage did not correspond accurately to market trend. And we can see that there is a greater element of the first rebalancing portfolio with the market movement, while the second rebalancing portfolio seems like more stable to market downturn due to a small sensible asset allocation. Although the return of first rebalancing portfolio has outperformed and higher than the market return, it's also feel to correlated with the overall market performance over the period. This is clear that difficulty of allocating a portfolio that consistently performs better than or matching with market return, which illustrating the needs of optimal allocation of assets and periodic evaluation. This is about the asset weightage of our investment portfolio. We have used the solver function in Microsoft Excel to generate a small suitable weightage. We have set constraint which is the total weightage must be equivalent to 1. There is no equal weight assigned to each stock in our portfolio formation. Public Bank Berhad has the higher weightage at around 53%, whereas Virtual Corporation Berhad has the lowest at around 9%. The share ratio of the fund portfolio is around negative 6.8947 with the expected return and the portfolio standard deviation. Due to its excellent financial condition and prospect for future expansion, YP Berhad retained its position as the largest portion of the initial portfolio and first rebalance. However, Mutual Corporation Berhad's metership decreased significantly from roughly 10% in the initial portfolio to 1.0473% in the first rebalancing. The weightage of Axiata Group Berhad and Gamuda Berhad fell in the first rebalance due to the addition of Pavilion Real Estate Investment Trust to the portfolio. In second rebalance, we reduced the weightage of Pavilion Real Estate Investment Trust from around 28% to 8.0767% to avoid greater loss. Besides, we also replaced investment in Mutual Corporation Berhad by the international stock, which is United Overseas Berhad Limited, with around 31% of the second rebalancing investment portfolio. We maintained the greatest investment in Public Bank Berhad, but decreased the weightage from around 51% in the first rebalancing to around 36% in second rebalancing. Since the weightage of Public Bank Berhad has decreased, we increased the weightage of Axiata Group Berhad and Gamuda Berhad. That's all from me. I will pass to the next presenter. Thank you.
In conclusion, our portfolio grew from 500,000 to 507,194 ringgit, achieving a 1.44% return. Despite initial losses, strategic investment in Gamuda Berhad and Pavilion REIT during the first rebalancing yielded profits. The second rebalancing maintained stability even in the market downturn. Although our portfolio's overall return was 1.43% lower than the market's 8.98%, strategic rebalancing and careful selection across sectors like financial service, real estate, and consumer goods ensure a balanced risk-return profile. Rebalancing in May and June 2024 optimized the portfolio, capturing market opportunity and delivering satisfactory results to the investor. Yeah, so that's all for our group. Thank you.